It was the gold rush of the digital age, until everything simply vanished. This was the biggest heist in history.
It started as a website for trading Magic the Gathering cards. It became the place where most of the world's Bitcoin was bought and sold. Then it lost 850,000 coins and called it a bug. This is Mt. Gox. At its peak, it handled 70% of every Bitcoin transaction on Earth. 7 out of every 10 Bitcoin trades in the entire world passed through one single exchange. Then, one day, in February 2014, it simply went offline, no warning, no explanation, just a blank page, where a trading platform used to be. When the truth finally emerged, 850,000 Bitcoin were missing at the time, worth approximately $450 million today at current prices. That missing Bitcoin would be worth tens of billions of dollars. This is Mt. Gox, the exchange that lost more Bitcoin than anyone has ever lost before or since, and the story of how it happened is stranger and more disturbing than almost anyone realizes. The exchange began its life with an almost unbelievable origin story. It was originally created in 2007 by an American programmer named Jed McCalebas, a trading platform, not for Bitcoin, but for trading cards from the game Magic the Gathering. The name Mt. Gox is actually an acronym Magic the Gathering Online Exchange, MTGOX, in 2010. McCaleb repurposed the Citito trade, the newly emerging cryptocurrency called Bitcoin, by 2011. McCaleb sold the exchange to a French programmer living in Tokyo. Mark Karpeles. Karpeles inherited an exchange that was growing explosively. Alongside the rising popularity of Bitcoin by 2013, Mt. Gox, based in Tokyo, Japan, was processing the overwhelming majority of global Bitcoin trading volume. It was, for most of the world, the place where Bitcoin was bought and sold. But behind the success, the exchange was a technical disaster. Karpeles, by most accounts, was a talented but disorganized programmer, was running one of the most important financial infrastructures in the emerging cryptocurrency world, with shockingly inadequate technical practices. Customer Bitcoin and the exchange's own Bitcoin were not properly segregated. Security practices were inconsistent. Code changes were made without proper review, and, most critically, the exchange appeared to have been losing Bitcoin to hackers and technical failures for years without anyone fully understanding the scale of what was happening. In February 2014, the exchange suspended all withdrawals. It cited a technical issue called transaction malleability, a known flaw in early Bitcoin software that could theoretically allow transaction records to be manipulated for days. Karpeles claimed this was simply a technical bug that needed to be fixed. Customers grew increasingly desperate. Then, on February 24, 2014, the website went completely blank. The exchange had collapsed entirely. Leaked internal documents suggested that approximately 850,000 Bitcoin belonging to the exchange and its customers were missing. On February 28, 2014, Mt. Gox filed for bankruptcy protection. In Japan, Karpeles held a press conference. He bowed deeply, apologizing publicly, a traditional Japanese gesture of contrition. He stated that the missing Bitcoin were lost due to a weakness in the exchange's system. For years, the cryptocurrency world debated what had actually happened. Was it a sophisticated hack that had been ongoing for years without detection? Was it gross technical incompetence? Was it, as some suspected, deliberate theft? In 2015, Mark Karpeles was arrested by Japanese authorities. He was charged with fraud and embezzlement, specifically related to allegations he had manipulated the exchange's computer systems to inflate his own account balance. He spent nearly a year in a Japanese detention before being released on bail. His trial continued for years. In March 2019, a Tokyo court found Karpeles not guilty of embezzlement and breach of trust, but guilty of one charge, falsifying financial records. He received a suspended prison sentence, meaning he avoided actual incarceration. Meanwhile, the investigation into where the actual Bitcoin had gone continued. In 2017, researchers and investigators identified a portion of the missing Bitcoin as having moved through accounts connected to a Russian operator of the BTCE cryptocurrency exchange. Alexander Vinnik, a Russian national, was eventually arrested in Greece in 2017 and charged with laundering Bitcoin connected to the Mt. Gox theft, among other allegations. He was eventually extradited and pleaded guilty in the United States in 2024 to charges related to money laundering. The full picture of exactly how 850,000 Bitcoin disappeared has never been completely and conclusively established. What is clear is that a combination of factors contributed: years of inadequate security, improper handling of customer funds code vulnerabilities that were exploited gradually over time, and possibly deliberate theft by external hackers who had been draining the exchange for years before anyone noticed the cumulative scale of what was missing for the customers. The bankruptcy proceedings became one of the longest and most complicated in cryptocurrency history. Because Bitcoin's price arose so dramatically in the years following the collapse, the legal question of how to compensate creditors became extraordinarily complex. Should they be repaid in the dollar value their Bitcoin was worth in 2014, or should they receive the actual Bitcoin itself, now worth dramatically more? The legal battles over this question took over a decade to resolve in 2024, 10 years. After the collapse, Mt. Gox finally began distributing repayments to creditors. Some received actual Bitcoin, some received cash settlements. The total value being distributed was estimated at several $billion, a fraction of what the recovered assets would theoretically be worth if simply held since 2014. So what is the real lesson of Mt. Gox? Mt. Gox happened at the absolute earliest days of cryptocurrency. There were no regulations. There were no established best practices. There was no industry standard for how an exchange holding other people's money should actually operate. A trading card website became the most important financial infrastructure in an entirely new asset class, almost by accident, and when it failed catastrophically, not necessarily through malice, but through a combination of incompetence, inadequate security, and possibly criminal exploitation that went undetected for years. The lesson of Mt. Gox is not just a historical curiosity. Every subsequent crypto exchange collapse, every subsequent story on this channel, happened because the lessons of Mt. Gox were never fully learned. That is the capital case. The first catastrophic failure in any new industry teaches the clearest lessons. The tragedy is how rarely those lessons are actually applied. Subscribe to the capital case because the next case is already waiting.